And today we are strapping in. We're looking at one of the market's most volatile stocks, Starfighter Space Inc. Ticker is FJET.
The drama here is just immediate. I mean, this stock recently spiked hard. It was flirting with $16 a share.
And then it just collapsed.
Yeah, it felt like a swift, brutal rug pull, the kind of move that just sends the retail crowd scattering for the exits.
But the source material we're digging into, specifically a piece called the Opening Bell Report, it sees this completely differently.
Right. They argue that drop wasn't failure. It was, and I'm quoting here, a necessary technical cleansing.
A cleansing that created a massive buying opportunity. And that's our mission for you today. First, we need to really understand why this $12 price point is being called a critical floor. Some analysts are even calling it a psychological fortress.
And second, we have to get really precise. We're going to outline the exact trade mechanics the report proposes. The entry, the stop loss, the targets. The risk is defined with, incredible precision.
Okay, so let's set the scene. The report calls it the technical crime scene.
I love that. So just recently, FJET opened strong, right around 14.15. It shoots up, hits a high of 15.88, so almost $16.
And then the selling starts. But it wasn't a cliff dive, right?
No, not a 1-minute plunge. It was a steady, heavy drift lower all day. It turned what looked like a beautiful green chart into a total rout by the close.
And when most people see that kind of price action, they think, okay, rally's over.
Yeah, it's breaking down, I'm out.
They're focused on that $4 loss from the high.
But the report, it just zeroes in on the low of that day. And this is where the whole story gets flipped on its head.
I have to admit, when I first read this part, I thought, oh, come on, this is just technical voodoo. But the report really forces you to look at one detail.
The precision. The stock did not stop at 12.10. It didn't overshoot to 11.90. It, quote, touched $12 perfectly and bounced.
And that perfect touch is the key insight. In high-frequency trading, hitting a big round number like $12 and immediately reversing, that is usually not an accident.
It speaks to pre-placed orders, right?
Exactly. Intentional pre-placed order flow. Think about the psychology of it. Round numbers are magnetic.
Yeah.
There were institutions, hedge funds. They often place these enormous limit buy orders.
And that's where the contrarian argument really picks up steam. The report interprets that perfect stop not as a bunch of retail traders getting lucky,
not at all,
but as hard evidence of institutional and algorithmic buying actively defending the line.
It's a deliberate action. It's a decision by the so-called smart money that FJET is just not allowed to trade below $12.
So instead of seeing a chart of a panic sell-off,
you should be seeing it as a protected accumulation phase. If these huge algorithmic players are defending $12, they're basically sending up a flare. They're signaling that, for now, that is the floor.
They've drawn a line in the sand.
And they are using their capital to hold it. It turns a chart of fear into a map of institutional conviction.
Which leads us right into this idea of the shakeout or the flesh out. The analysts argue this huge drop from almost 16 down to 12 wasn't just, tolerated by the smart money.
It was desired in a strange way.
Yeah, desired. So explain the mechanics of that. Who is getting flushed out here?
The report calls them the weak hands.
Right, the weak hands.
So think of it this way. These are the momentum chasers. They saw FJET ripping past $15. They piled in late, probably with high leverage.
So when the stock drops just $1 or $2, their emotions or their margin calls force them to sell.
And they sell at the absolute worst possible time, right into that $12 floor that the institutions have built.
It's a classic market maneuver. It's like a construction crew building a foundation.
Right.
Before they pour the concrete, they have to clear out all the loose debris.
Right. This volatility is a debris clearing. The report says the market needed to shake out the weak hands to make sure the stock is actually held by investors with real conviction.
It's compelling. It really does transform chaos into a purifying ritual. But okay, let me play the skeptic here for a second, because I know you're thinking this too.
Go for it.
If the stock just dropped $4 in one day, isn't it possible the drop to 12 actually scared new buyers away? Is the stock now just sitting there, illiquid? Are we sure the selling is truly exhausted?
That is a critical point. It's about volume and conviction. The source suggests that the heavy selling was mostly emotional. It was a cascade of stop losses and panic selling, not a fundamental shift from institutions.
Because it stopped right at 12.
Exactly. Because the price stopped perfectly at 12. The assumption is that those big pre-placed institutional buy orders just hoovered up all that selling.
So if the weak hands are gone and their shares were bought up by institutions, the whole supply-demand balance just shifts.
It shifts dramatically. Any sellers left find fewer and fewer buyers until the price has nowhere to go but up. The stock has migrated from impulsive retail accounts into the hands of the smart money who are just patiently waiting.
Okay, so we've covered the technical and the psychological case for this $12 fortress. But that is only half the picture. The report is very clear. This isn't just about lines on a chart.
Right, we need the fundamentals. Why does a sophisticated algorithmic trading fund even care about holding a line for Starfighter's Space Inc.?
The report just dismisses the idea of FJET being some paper company that only puts out press releases. Their value is anchored in something tangible, something very hard to replace.
And that anchor is their specific hardware.
The F-104 fleet.
Yes, this is their fundamental moat, and we really need to explain this. The F-104 Starfighter, I mean, this is a legendary supersonic jet from the Cold War.
And FJET doesn't just own one or two, they have a functional, flight-ready fleet of them.
So the question is, why is that specific vintage aircraft still relevant today?
It's because of the new space economy and the race to hypersonics. The F-104 is one of the only commercial platforms that can operate reliably at extreme speeds and altitudes.
We're talking about the edge of the atmosphere, the exact place where tons of new aerospace and defense tech needs to be tested.
Exactly. So what here is all about capacity and regulatory hurdles. Every time NASA or a big defense contractor or a private space company needs to test a new sensor or a payload release mechanism,
Or a component for a hypersonic vehicle.
they need a dedicated, proven platform. FJET provides that service. It's a niche, but it's an irreplaceable niche right now.
And the report really stresses this. You can't just 3D print these capabilities overnight.
No, you can't. Building a new rocket is one thing, but acquiring, maintaining, and certifying a whole fleet of hypersonic jets for this kind of testing, that is a massive operational and regulatory mountain to climb.
FJET already has the infrastructure. The pilots, the government certifications, the whole 9 yards.
And if you connect this back to the market, that current $12 price is viewed as a massive discount. You have to remember, earlier this year, this stock hit $31.50.
Now, that price was likely driven by a lot of hype and speculation for sure.
Of course. But it provides that baseline. It shows you what the market thought this company could be worth. So this correction is seen as a significant and now protected discount on a fundamentally unique asset.
So you have an irreplaceable asset, plus you have algorithmic defense at $12. This is what leads the analyst to lay out a very specific step-by-step game plan.
And this is the part you really need to understand to grasp the opportunity here. So let's get clinical about the risk and the reward.
Okay, let's do it.
Step 1. The buy zone. This is the optimal entry defined by that institutional action we talked about. It's anywhere between $12 and $12.40.
So you're respecting the floor, but you're allowing for a little bit of slippage on your entry.
Exactly. Now, step 2 is maybe the most important part of this whole thing. Risk control. The entire thesis is built on that $12 fortress holding.
So the stop loss has to be tight.
Incredibly tight. If the stock breaks below $11.50 with any real volume, the bullish thesis is broken, the algorithm's failed, you get out immediately.
And that requires a lot of discipline. You're risking only 50 cents from the low end of that buy zone. You're admitting right away that if the smart money is wrong, you're wrong too, and you're getting out for a small, defined loss.
But the reward potential is why the report highlights this setup. The targets are two-tiered. Target 1 is a recovery move, a gap fill back to $14.
And a gap fill, for anyone who doesn't know, is just the price returning to a level where it traded before, where volume dropped off. It acts like a magnet.
Right, so that $14 target is just a simple recovery of the recent losses.
And target 2 is the big swing.
That's the one, retesting those recent highs at $16. This implies full confidence that the shakeout worked and the stock is ready to resume its climb.
So let's just do the math on this, because this is where it gets really compelling. If you enter at $12, your defined risk is 50 cents, down to that $11.50 stop.
Right.
If you hit target 1 at $14, you've made $2. If you hit target 2 at $16, you've made $4.
You're risking 50 cents to potentially make $2 to $4?
That's a minimum 1 to 4 risk to reward ratio. The source is explicit about this. A trade with that kind of favorable ratio doesn't even have to be right all the time to generate huge returns.
Provided, and this is the key, you stick to that strict stop loss.
Absolutely.
Yeah.
So let's just synthesize the whole picture for you. We've looked at the technical bounce at $12 as institutional defense.
We noted the steep drop was a crucial market cleansing that got rid of the impatient traders.
And we established that the F-104 fleet provides a fundamental, irreplaceable moat that justifies that institutional interest in the first place.
So the setup from this report is a specific, highly defined, high-reward entry point. And it is all predicated on the strength of that $12 level. It's an exercise in capital efficiency.
Which brings us to the philosophical takeaway that underpins this whole strategy. The report concludes with a simple, powerful law.
The market transfers money from the impatient to the patient.
That's it.
I mean, think about the two parties here. The impatient chased the stock near 16, they panicked on the drop, and they sold their shares.
To the patient people. The ones who were waiting with cash on the sidelines at $12, the patient let the volatility happen, they defined their risk, and they entered at a protected price.
That is the power of waiting for a setup versus chasing momentum.
And that patience is rewarded with that incredible risk ratio. But here's the thought I want to leave you with, especially when we talk about that algorithmic defense.
Yep.
If $12 is truly protected by institutional and automated buying, what specific fundamental news or catalyst could actually break that psychological fortress? I'm talking something structural, like a regulatory change, or maybe a competitor finally acquiring similar capabilities. What would it take to break that floor? And how would the failure of that line fundamentally change the long-term outlook for FJET?
That is the risk everyone defending this price has to constantly be thinking about.